Thank you everybody for joining today, our last webinar of 2025. I know it's a busy run up to Christmas, so thank you for finding the time. In previous years in December, we've done forward looking what's coming up, but this year we thought we would look back over the year and see what trends and topics we have seen across the industry that we thought you might like to see about and that might run into 2026. We've called it Beyond the Regulation because the plan was not to talk about any regulation, but this being travel, we can't avoid it, and there have been some updates that Farina's going to talk about. So there is a little bit of regulation for all of those that love it, which we know is everybody. The topics we're going to cover today, as I said, Farina's going to look at some of the recent updates from the CMA guidance and the latest PTR reform consultation that's just come out. We're then very happy that we're joined by a couple of colleagues from our disputes team and our payments team. Kofi Mills-Bampo is going to give us an update on the UK's failure to prevent fraud offence, which is applicable to travel companies and where we're at with that. Chris Hill is going to talk to us about some of the payments issues that he's seen this year, and I will be looking at some bed bank issues. Again, it's been a common theme with some of these this year that I will talk about. So a little bit of housekeeping. Everybody is on mute with cameras off. Please do ask us questions as we go through using the Q&A function at the bottom of your screen. We'll field questions at the end, probably. We may do them as we go through, but probably at the end, so do send them in as we go. The session is being recorded and we'll circulate slides afterwards for you to share around your teams if you would like to. So without further ado, I will hand over to Farina.
Thank you, Lucy. Yes, so as Lucy mentioned there, when we were putting the agenda together, for this webinar, we thought it would be a really good idea to sort of look beyond the regulation, but that has not happened because since putting the agenda together and actually having the webinar, we've had two pretty hefty updates that it would be remiss of us not to cover off really in this webinar. So the two things that I'm going to look at is the CMA guidance on price transparency and also PTR reforms, which we received an update on last week. Firstly, looking at the price transparency rules and the CMA guidance. So as many of you know, the Digital Markets Competition and Consumers Act, the DMCCA, came into force earlier this year. So it replaces the Consumer Protection from Unfair Trading Regulations 2008, which I'm sure many of you know very well. And it prohibits unfair commercial practices such as misleading acts and omissions. So price transparency is one of the areas that has been sort of strengthened, or at least we've got more guidance on under the DMCCA. And price transparency really is or it includes being sort of a misleading omission if the total price of the product is not disclosed to a consumer in an invitation to purchase, and then obviously all the way through the customer journey as well. So an invitation to purchase is basically any commercial communication that gives the consumer enough information about a product and its price to enable them to make a transactional decision. And it doesn't require the consumer to actually go ahead and complete the purchase. They just have to have enough information to decide whether to take a step in the purchasing process. So, for example, sort of a holiday advert with a price and a brief description, that would be considered an invitation to purchase. And under the DMCCA, there is sort of certain mandatory information that you have to provide with an invitation to purchase, and that includes the total price. So the CMA has issued some detailed guidance, the final version of which was released a few weeks ago, and it's specifically aimed at sectors like travel, where pricing can be quite complex. And so we just thought it was sort of useful to kind of go through this final guidance. You will probably remember the draft guidance came out in the summer, so it came out in July. There was a period of consultation where sectors could have their input, and then we've got this sort of final guidance now. So firstly, looking at sort of drip pricing. So The DMCCA is very clear. There's a strict ban on drip pricing. So drip pricing is when a business advertises a headline price, but then adds sort of mandatory fees and charges later on in the purchasing process. So it's not there in the advertised price. It's not there in the invitation to purchase. And so that means a customer only discovers sort of the true total price of the product step by step or drip by drip as per sort of the name. And that's sort of they only discover that as they move through the journey. So that is prohibited under the DMCCA, and the headline price that you present to customers must include all unavoidable charges. So we're looking at things like resort fees, compulsory cleaning fees, booking fees, or mandatory city taxes. So they can't be added later on in the customer journey. They have to be in that headline price, in that advertised price, when it's when it's being presented to the customer. So I'm going to talk a bit more about local charges in a bit more detail on the next slide. So I'm just going to put that to one side for now and we can come back to it. The second point that I just want to talk about is partitioned pricing. So again, partition pricing is prohibited. So you can't just list the components, sort of it would be sort of where you were sort of showing £100 room fee, £20 resort fee, £50 cleaning fee, but you're not showing the total of that. So it's basically up to the customer to kind of add that up and work out what the total is. So that's not permitted. So you do have to provide a single consolidated total price wherever the total is reasonably calculable. So where the total price genuinely can't be calculated up front. So for example, if there's a charge that varies based on the number of travellers, what you have to do instead is give a clear and prominent method for calculating it. So it can't be hidden in the small print, and it's got to be easy enough that essentially the customer can work out for themselves. So you've got to provide enough information that the customer can calculate what that fee must be. But in the CMA's guidance, you'll see that they consider this to be relatively rare, where you can't actually calculate a charge up front. They would consider most fees, especially things like local charges, to be fees that can be calculated in advance and then shown in the headline price. And then the last point on this slide is just around from pricing. So your from prices must reflect real availability. So it must be realistic. So you can't be using off-season pricing to promote peak season deals, for example. It's got to be attainable. So that means available to a decent proportion of customers. And it also has to be genuinely representative. So it can't be based on a very narrow or atypical window of availability. So essentially all of this to say, avoid misleading from prices. So going into a little bit more detail on local charges, this is obviously quite a travel specific charge, and it's one that the guidance does address specifically, the CMA guidance that's been released. So the CMA's view is that if a charge is compulsory, so whether it's a local tourist tax, a resort fee, or anything similar, it must be included in the headline price. So it doesn't matter whether the charge originates from a local supplier, it doesn't matter whether it's collected locally at the destination, and this even applies where the charge is payable locally and in a different currency. So CMA's view that if it's unavoidable, it can't be treated as an optional extra. It has to be built into that upfront price that is shown to customers when it's being advertised. So where the local charge is payable in a foreign currency, if you are advertising your prices in pounds, which you're obviously likely to because you're advertising to UK consumers, you have to include that local charge in those headline prices, even though it's in a foreign currency. And so what that means is that you may need to convert it from the local currency into pounds to be able to include it in that headline price. And what you would then have, and what the CMA would like you to have then is a sort of a pay now and a pay later. So you would have the pay now fee, which would be the amount that is payable to you as a travel company, and then you would have the pay later price, which would be in the foreign currency, payable to, for example, the supplier. So you are required to provide a clear breakdown of what the customer will have to pay and when. And if the amount to be paid later is going to be charged in a foreign currency, subject to limitations in time and space, the details of the exchange rate conversion, which is used to calculate the local charge, should also be provided. If that breakdown can't be provided in the advertisement itself, so if you don't have the time or the space to do that, it must be provided no later than at the stage at which the consumer will complete their booking. So that's just something to be aware of, where you do have sort of a pay now, pay later price. And the last point that I just want to touch on this slide is around intermediaries. So if you are an intermediary, so if you're an OTA, if you're a booking platform, if you're a retail agent, you are also liable for the prices that are being presented to the consumer. So if there's a mandatory local charge that hasn't been included in the price that you are displaying as the intermediary, it's not a defence for you to be able to say, oh, the supplier didn't actually provide us with that, so we weren't aware that there was this charge in. Under the DMCCA, you are responsible for ensuring that the prices that you're presenting are total. So you're presenting the total price and it is accurate at that point of presentation. So you do also have liability under the DMCCA for presenting that total price. So I just wanted to include this particular slide. So this does come from the CMA guidance, and it's a practical example of how the CMA thinks compliance should look like. And in this hotel checkout screen, you will see that we have the total price, including the local tax. So that is the total of £500 and 50 pence. So that includes both the pay now and the pay at the property price. You then have the breakdown, which clearly shows the amount to be paid in pounds now, the amount to be paid at the property in euros, the exchange rate that has been used, and then the approximate sterling value. So that is the level of clarity that the CMA expects from you. So the key point essentially is that if the charge is mandatory, it needs to be reflected in that total upfront price. It can't be hidden, and it can't be a surprise to the customer, to be paid at the hotel. You may be aware that earlier this year, the CMA did launch a package of enforcement action against a number of businesses, and they sent out around some advisory letters to 100 businesses. And out of those 100 businesses, the largest number of letters went to businesses in the travel sector. And the CMA has actually since also confirmed that there are currently 8 businesses that are being investigated. Now, they didn't say the sector, so I don't know whether they're in travel, and I'm sure they're not all in travel, but 1 or 2 of them may well be. And the issues that those investigations relate to are drip pricing and misleading online practices. The direct enforcement powers that the CMA now has under the DMCCA are very actively being put to use. And the enforcement landscape, as a result, has completely changed. So it's more important than ever that businesses do comply with these rules, and in particular, these rules around price transparency. Okay, so I'll move on to PTR reform. You'll recall that earlier this year the PTRs were consulted on, and there were a number of proposals that were put forward, and that included deregulating domestic packages, changes to linked travel arrangements. The government was looking at how to make insolvency protection arrangements more flexible, and they were also looking at how tourist services formed part of those rules. And then last week, we received the update on that consultation and which proposals the government was going to go forward with. And after all of that consultation, all of those proposals, there are actually only 2 key changes, and they relate to linked travel arrangements and supplier redress. But they are pretty significant changes, especially the changes around LTAs, which I will look at in a little bit more detail. So with the LTAs, one of the most significant changes is that what we currently call an LTA Type A will now be treated as a package holiday. So a Type A LTA is where you have the separate selection and separate payment of 2 or more travel services for the purpose of the same trip on the occasion of a single visit to a trader's point of sale. So that will now be a package. So That means whenever a customer books an additional travel service during the same visit to a point of sale, it automatically will now be classified as a package, even if there are sort of separate payment and separate contracts. So what that means is, an LTA Type A, which only had sort of very limited insolvency protection and information requirements applied to it, will now attract full package rights. We've then also got quite a significant development in relation to Type B LTAs. So these have essentially been abolished. So they've decided to get rid of Type B LTAs in their entirety. So Type B LTAs were arrangements where a trader facilitated a second booking within 24 hours of the first booking. So the most common example you used to see pre-2018 used to be that of airlines. So you would go on to an airline website, you would book a flight. Once you'd booked that flight, on the confirmation invoice page or even in your confirmation invoice email, you would get links to be, to be able to book accommodation for those dates that you've just booked the flight for in the area that you've just booked the flight to. So it'd be that targeted communication. And if a customer under Type B, if a customer then clicked on that accommodation link and proceeded to make a booking within 24 hours of having made the flight, that would be an LTA Type B. And as I said, that was quite common pre-2018. Once that turned into an LTA Type B, you saw less and less of it. And so, traders would essentially hold off for 24 hours before trying to, upsell the accommodation. And the findings of the consultation was that the Type B LTAs, they created confusion, they added limited consumer value, and that they were used quite inconsistently across the industry. So they've been taken out of the LTA definition. They've been removed in their entirety. So it basically means that these facilitated bookings will fall outside the scope of the PTRs unless somehow they independently qualify as a package. So the second area of reform is in relation to PTR Regulation 29, so supplier redress. So Regulation 29 deals with an organiser's ability to recover money from suppliers when a package is being cancelled. And the old wording of Regulation 29 did cause some confusion because it referred to an organiser's right to seek redress from third-party suppliers in relation to, cancelled holidays, for example. And that has now been clarified that it is actually a right to redress. And the government has emphasised that it's a statutory right that organisers have against their suppliers. The reform also introduces a clear 14-day deadline for suppliers to refund organisers, which then obviously gives organisers hopefully enough time to be able to pass that on to customers within the 14-day deadline that organisers have to refund customers as well. So it's quite a positive development for organisers who have previously struggled, especially during the pandemic, to obtain refunds and have had to wait, really significant periods of time sometimes to actually receive refunds from their suppliers. So it's quite positive development, we would say. And then just lastly, just to sort of mention some of the things that were consulted on, but then not taken forward. And actually, most notably, is the government's decision not to exclude domestic no transport holidays from the PTRs, which they seemed quite keen to do. And you sort of looked at the consultation earlier this year, and it looked like that was really something that was going to happen. But the decision has been that they considered that the risk of taking domestic no transport holidays out of the PTRs meant that consumer protection would be weakened and the overall PTR regime would become less coherent. And around sort of flexibility around different forms of insolvency protection, the update does note that, that there was quite a lot of support for that in the industry, but it has decided not to make any major structural changes at this stage. So we are expecting legislation by June 2026, so it's really not that far off. We're hoping that we will see some draft wording at some point so we can really see how this is going to be implemented into the PTRs. And as always, as and when we do receive these updates, we will let everybody know. Okay, so that is me. I will now hand over to Kofi, who's going to talk to you about ECCTA.
Thanks, Verena. Good afternoon, everyone. As Lucy mentioned at the start, I'm a partner in the disputes team here at Fox Williams. And one of the areas I specialize in is disputes and investigations involving fraud issues, including in relation to the travel sector. So I want to spend just 10 minutes giving a brief overview of the new corporate criminal offence of failure to prevent fraud, which came into force in the UK in September of this year. So we're going to briefly cover what the offence is, how it's engaged, why it's relevant to travel companies, to companies in this sector, and then conclude with just a few brief points for ensuring compliance. Okay, so the slide you see on the screen now sets out the primary offence, which was introduced as part of the Economic Crime and Corporate Transparency Act of 2023, known as ECCTA. As you see, it basically provides that a relevant body, which is a large organization, will commit a criminal offence if an associated person commits a fraud offence which is intended to benefit the body or to benefit some other person who receives services on behalf of the body. So the essence of the crime, of the offence, is that if a person associated with your organization commits a fraud offense and one of their goals is to benefit your organization or to benefit someone else who receives services on your behalf, then the organization is guilty of a criminal offense. There are a few key points, therefore, to draw out in terms of understanding this offense. The first and most important point to be clear about is that this is a strict liability offense. So there is no requirement that your company or organization had any involvement in the fraud, or even that you had any knowledge of the fraud. All that is required, subject to being a qualifying organization, is that there was a fraud offense committed by an associated person and that it was intended to benefit you in some way, even if that's only indirectly. So the second point to keep in mind in terms of just understanding this offense is that it applies to relevant bodies that are large organizations. And to be clear, any company or partnership will qualify as a relevant body, so we can ignore that effectively. The slide sets out, therefore, what a large organization is for these purposes. And these criteria are set out at section 201 of ECCTA. And as you can see, there are three key criteria for this. Your organization needs to fulfill two of the three. So net turnover of more than £36 million, net assets of more than £18 million, or more than 250 employees. And I should note that if an organization is the parent of a group, then the test is applied on an aggregate basis for the group as a whole. We'll come back to this large organization criteria in a few moments when we consider why this is relevant for travel companies. The third key point to keep in mind in terms of understanding the offense is that the associated person, so the person who commits the actual crime, that associated person can commit a wide range of underlying fraud offenses. So the slide sets out just a few of them, but it is a very full list. And if you want to see the full list, they're all set out at Schedule 13 of ECCTA. Within the travel industry, this could cover fraudulent acts in relation to financial reporting, regulatory reporting, the processing of payments, customer communications and marketing, and shareholder communication, just to give just a few examples. If any of the relevant fraud offences are committed and your organization benefits in any way, then if it's a qualifying organization, the starting position will be that you have committed an offence. I should also add for completeness that an associated person is very widely defined in the legislation. So according to section 1997, it includes employees, agents, subsidiary undertakings, or any person who performs services for you or on your behalf. So why is this relevant to companies in the travel sector? Why does this matter for you? There are really three key reasons, I think. First, because even if your company is not a large organization, you still need to be conscious of this legislation and you can still potentially be caught. If your company is a subsidiary within a larger group, then there will be potential liability if the parent company qualifies as a large organization. So what that means is you need to consider the corporate group as a whole, even if your specific entity is far from a large organization under this test. The second point is that going back to what I mentioned earlier about this being a strict liability offense and the wide definition of an associated person, your organization can potentially be caught by the actions of people over whom you have no direct control and indeed no direct oversight. So, for example, distributors, sales agents, all forms of outsourced employees, and in particular, anyone who is dealing with end customers, so retail customers, or with shareholders or with regulators, could potentially commit fraud offenses for which your organization may be held criminally liable if it can be said to have benefited in some way, even if that's indirect. So effectively, the scope of potential liability has been widened for travel companies by this legislation. And you now need to think about the entire commercial supply chain for your company right through from whatever it is that you are doing to the end customer or the end regulator or the end shareholder. The third key reason this matters for the travel sector is because the associated person doesn't actually need to have committed the fraudulent act themselves for you to potentially be caught. And that is because if the associated person in any way aids, abets, or counsels, or procures that somebody else commits one of that broad range of offences, then that is itself a qualifying fraud offence under ECCTA. And so your organisation could be found liable for failing to prevent it. So as you can see, on the face of it, this is a very broad and quite draconian new imposition of criminal liability for companies. And so the obvious question arises, well, how do we manage that risk? The short answer is that the draconian nature of the offence is balanced out by the defences that you see on the screen. There are two key defences. The first is that the relevant body, i.e. your company, had in place such prevention measures as it was reasonable in all the circumstances to expect it to have in place. In other words, you had reasonable procedures to prevent fraud. And the second is that it was not reasonable in all the circumstances to expect the body to have any prevention measures in place. So, you didn't need any prevention measures. Now, what reasonable procedures will be in any particular case or for any particular company is very fact sensitive. It's going to depend on the circumstances. But there are a few sort of key general points to keep in mind just to conclude. The first is that you have to think carefully about whether fraud prevention measures are needed for your organization. And what that means is you have to carry out a comprehensive and well-documented risk assessment. So there is government guidance on what should go into those kinds of risk assessments. We have reviewed risk assessments for clients. But if you do not carry out that exercise in a well-documented and justifiable way, then it will be very difficult, even if there was a fraud committed by somebody in another jurisdiction that was very hard to foresee, that was, really a one-off. It will be hard to resist liability if you are a qualifying organization, if you can't show that that assessment was made and that there was a reasonable basis for whatever procedures your organization has. That's the first point. The second point is that any prevention measures need to take into account the overall structure of your organization and its wider corporate group. So this is coming back to the point that a parent company can be the qualifying large organization for these purposes. So it may be that in a group setting, you need group policies to cover the corporate group as a whole, and individual policies for particular business units or subsidiary entities. And obviously, the measures will need to be sensitive to local laws and local restrictions. The third key point for managing this risk is to be mindful of the level of control that your organization may have over its supply chain and over other parties with whom it does business, right? So, what degree of bargaining power do you have with your commercial counterparties? And in that context, it's important to consider whether you ought to be seeking some form of formal reassurance or undertakings from other parties you do business with in relation to what they are doing to prevent fraud, if there is a realistic possibility that those other parties could be seen as associated persons of your company. And finally, I would say that it's possible that many of the kinds of procedures that you will be expected to have are already in place. So, for example, if you are a regulated firm, you are likely to already have suitable systems and controls, and it may be that you already periodically carry out compliance reviews, and so I say all that to say it's not all doom and gloom. You may have much of this covered already, but again, you won't know that, and you won't be able to properly evidence that until you've carried out a risk assessment. So that's all I wanted to say about the failure to prevent fraud offence, but you should expect that this will be a continuing obligation, and that there will be over the coming year a focus on companies showing that they've got the proper procedures in place. Okay, I think I'm now going to hand over to Lucy to talk about bank contracts.
Thank you, Kofi. So I'm going to spend hopefully no more than 10 minutes on a topic that's I've seen quite a few times over the last 12, 18 months. And it's not by any stretch a new concept, but whether it's more forefront for clients because of the consumer law changes, the DMCC, I'm not sure, but we've just seen more of them. Again, not a new construct at all. Bed banks, and I've called it bed banks, but they're just an example of a B2B intermediary, obviously, that sits between the agents, the tour ops who are selling directly to the consumers, and the ultimate suppliers. Bed banks are specific to accommodation, of course, but they call themselves distributors. There's a question over what they are legally, but distributors, aggregators, and distributors of flights, car hire, experiences, ancillaries. The B2B travel tech market is booming, and so there are more and more of these intermediaries, I think, coming online, and they obviously offer the agents, the tour ops, more inventory, more available. But the issue with all of this, and the reason for talking about it, is that it removes obviously that direct link between the agents, the tour ops, and the ultimate suppliers. And so the question of what risks that manifests, or greater risks it manifests, and how to manage that is the question I think that people are grappling with a little bit more at the moment. So I think I bit off more than I could chew, thinking I could cover all of these points in 10 minutes. So I'm just going to focus on the top three, and I think they are the more salient ones anyway. Obviously, if what you're buying through the intermediaries, through the bed banks, you're including it in a package. You have your PTR obligations and liabilities. You're liable for the performance of the package and the non-performance of the package, and any failure of it in between. You're also on the hook from the consumer with the accuracy of what you're selling, and most of these intermediaries just provide an API. It's a data feed. Sometimes there is media. You'll get photos, but you need to know that what you are getting is accurate, because you will then be obviously passing it on to the consumer and selling it. And as Farine has talked about, inaccurate pricing is now much more of a risk, perhaps, than it ever has been. So they're probably the biggest risks that you consider when you start looking at these contracts? And the contracts are they vary from not mentioning anything to do with the end supplier, the intermediary just being a distributor of digital content, which that they are, but they're also not. They are intermediating and distributing travel services, which somebody will consume. But I think a lot of the bed banks, the intermediaries, are not UK businesses. They're global. It's a global business, and the risks that agents and tour operators are now seeing under the DMCC Act, they're not aware of, and so the contracts certainly don't deal with. It's certainly not the DMCC. Often not even the PTRs. Some of them do, but the starting point, if you receive one of these, is that it doesn't offer you much comfort for the things that you actually that you need it to cover. Like I say, some are better than others. Linked to those PTR risks and the obligations is obviously customer claims. If something does go wrong, how is that managed? What does the intermediary allow you to do through its platform, through its technology? Does it offer any support? Because you don't have this direct link with the suppliers, and there's a lot of obviously commercially sensitive information that flows up and down the chain. Sometimes you're not allowed access directly to those suppliers. So what does that mean for you from a customer claims perspective? How do you manage it? And obviously linked to that is what kind of indemnity cover, any kind of insurance cover protection do you get if there is a claim from a customer, whether it be for non-performance, i.e. customer turns up at a hotel, a flight, an activity, and there's a double booking, they can't get on. What does that mean? That falls to you under the PTRs. And even if it's a single source transaction, it's not a package, there is this duty of care that you have to your customers that you need to try and satisfy. So what is the sort of indemnity cover that you're offered, if anything? And if you are offered something, what does it cover? Something like negligence doesn't cover non-performance, for example. The double booking isn't captured. And also, if there's a sickness bug in a hotel and you get 100 claims, that may not have arisen from negligence. So that often you're obviously not offered as a starting point what it is you actually need, or what you hope you would get if you were dealing directly with a supplier. So they're probably the two biggest categories of risk that these contracts create. And then the third one, the number 2 in the list, the intermediary concept. Legally, if you are an intermediary as a legal concept, doesn't mean anything. You either have to be an agent, a distributor, a reseller, or a principal. And the blurred lines between what these B2B businesses are matters when it comes to disclosure to the customer, whether you're a disclosed agent or an undisclosed agent in VAT terms. Obviously, the VAT that you pay, the tax that's included on the pricing that you get down from the supplier, that has an impact. And again, your booking terms and conditions, describing your role, and when we're talking about packages, if it says an agent and a sub-agent chain rather than a principal agent chain, that's the difference between a single contract package and a multi-contract package. So there are all these things to think about depending on what role the B2B intermediary plays. And like I say, it's not always clear or transparent in the first case. They're the biggest risks. I'll move on now to sort of how to manage them. If you can move to the next slide, please, Bailey. So there are just some ideas on the slide here. So there isn't, sadly, a silver bullet. There is no sort of one answer fits all for any of these risks, and there is no a lot of this is it's negotiation. There's no kind of legal requirement on these intermediaries like there is at the consumer level, at the B2C level, to have to accept any of these risks. So a lot of it depends on your risk appetite, your insurance cover, and how much of an important customer you are to these intermediaries, and how far you could get in negotiations. So just some ways to think about how you address, say, the PTR risks that arise. Health and safety is probably the biggest one that comes to mind. Are you given access, could you be given access to the intermediary's health and safety management system? As an example, that would be the ideal, making sure they have a health and safety management system, or are at least doing the checks that you would ordinarily do if you were directly contracting with the suppliers. Those health and safety audits, those health and safety checks, what are they doing? How much reliance can you get on what they're doing? How much information do they share? And what warranties you can get contractually that they are carrying out these checks and that the information that they're providing with you is up to date, accurate, but that sort of comfort, what comfort can you get contractually, is one way of you managing your risk and being able to show that you are managing that health and safety risk that you acquire effectively under the PTRs. Once if you've signed the contract, you then have ongoing compliance, internally monitoring which suppliers you might get claims for. Can you turn off some suppliers if you get more claims about one than another? That ability to, it's not every supplier that the intermediary offers. There is a way to switch them off usually. And also keeping internal records so that you've got that audit trail in case there ever is an issue, that you've done as much as you can as another intermediary to satisfy claims or help satisfy those claims. That's the health and safety side. The information and pricing. There's a real mixture that we see on what warranties, what guarantees, comfort are given around the information that is provided. If it's just a data feed, the intermediary is not going to stand behind information, data that it's collected from the end suppliers. But that's exactly what you need, especially on pricing, for example. Are all taxes, are all local taxes and pricing included in that price that you are getting? And sometimes there is a restriction on being able to change that price. So you need to think carefully about what it is you're getting, what information you're getting, and what comfort you need from those intermediaries, and a negotiation on what they're willing to give. In terms of sort of customer claims and management, we've seen some intermediaries not offer anything. They don't want to get involved because customer complaints are nothing to do with them. They are just an API feed. You, in your business, you know whether you want to manage claims, control claims, or whether you pass them to the hotel. That negotiation of just how complaints are managed is a really key one. And you will find, hopefully, the middle ground, what works for you with sort of first line support versus second line support, perhaps. But one of the key things to get in there is making sure sort of communications are passed on immediately, promptly, because the intermediary at least should be doing its role as an intermediary of passing on communication. The ideal is that you are allowed to be put in touch with the supplier directly and it gets managed that way, albeit you still don't have that contractual link with the supplier. You do still have a sort of day-to-day right to contact them, even if it is through the intermediary platform. But all things you need to think about. Key point on indemnities is, are you given one? Are you offering one if you are the intermediary? And the question is, how much protection cover do the intermediaries themselves get from the suppliers? What I didn't show on the slide with all the parties was the lines between each party, because I started putting them on, but there are lines everywhere. You may have a chain of intermediaries which you don't know about. If you're buying from one, they may aggregate, they may sort of pull in from other aggregators before the ultimate supplier. And so that back-to-backing of indemnity cover is obviously feeds into how much the agents and tour operators can get from the intermediaries. Like I say, there is no one answer, no one size fits all. But as an agent tour op, you know what you need. The question is, what is the intermediary willing or able to give? Who bears the risk for things like double bookings or sickness bugs? Where does that risk sit? So that's those two topics. And then finally is, this intermediary concept. I think you need to understand what type of intermediary you are dealing with, because it has a tax implication. And that's not anything I'm going to talk about now, but your tax team will need to get involved to understand the money flow, the VAT side of it, what you can disclose to customers, what you should be disclosing to customers. And if you're dealing with flights as well, what ATOL certificates have to include about the single versus multi-contract packaging. If you're an agent of multiple suppliers, you're offering a multi-contract package. If you are assuming the role of a principal, you are offering a single contract package, different ATOL certificates. But if an intermediary above you in the supply chain is an agent, are you buying in as a principal, or are you effectively a sub-agent? Understanding that is absolutely key. Say something your tax team or tax advisors need to be involved in. So that is a topic in itself. Hopefully that's given you some flavours of the things you need to think about. And obviously always happy to talk them through with you if you're thinking about starting to contract in this way, if you don't already. So last up, I will hand over to Chris to talk about payments.
Thank you, Lucy. Good afternoon, everyone. So this is going to be a little bit of a whistle-stop tour. As mentioned at the beginning, I'm a partner in the FinTech and Payments team. And I end up working with our travel team quite a lot, because there's obviously a lot of payments, a lot of money flows going around in travel, and it's often quite a complex area. So first things first, what are regulated payment services? Why are we bothered about this? So there are two bits of law, the main bits of law governing payments in the UK. We've got payment services regulations, which come from PSD2. Which also govern open banking. There's also the e-money regs, the electronic money regulations, which are about issuing e-money, which can bleed over into things like loyalty schemes. The reason we're talking about this, and the reason it keeps coming up in the work that we do with travel companies on the payment side, is because the lines are sort of very finely drawn. Wherever you are doing anything to do with creating accounts, creating wallets, if you're involved in the funds flow at all, which is often the case in many business models in travel, if you are issuing payment instruments, ways of paying that, then it is likely that you are inside or right on the edge of the payments regulations. If you are carrying out one of these activities without the proper authorization, or without sort of piggybacking off somebody else's authorization, it's actually a criminal offence to be doing so. So it's something that needs to be taken seriously. What we find very often is that people get into trouble when they have an existing business model that they have checked out, and it's all fine. And then they make a couple of changes. You're only ever one bright idea away from a regulatory breach if you're involved in the funds flow at all. So it's something that's very much worth keeping a close eye on when you're doing product changes, money flow changes. It's worth doing the analysis, documenting how you've done it, and just keeping track of any future changes. Now, it's not all doom and gloom. There are two major exclusions that come up a lot when we're dealing with travel companies. The commercial agents exclusion and the limited network exclusion. So Essentially, this means that although you would otherwise be within the remit of payment services regulation because you're involved in the funds flow, you're taking the money in and passing it on to somewhere else. If one of these exclusions applies, then you get taken back out of that, but you obviously you have to continue to comply with the requirements of the exclusion. The commercial agents exclusion is the one that we see most with OTA models, particularly where you're dealing with some kind of merchant of record. It applies where a company is acting on behalf of one side of the transaction and has authority to bind the principal. So in a typical merchant of record model, that will be where an OTA is taking the funds in, but in return for the funds being taken in, the customer is automatically bound to the contractual terms of the hotel, the airline, the travel provider of some kind. This comes out of PSD2. There's this sort of rather odd thing where it talks about acting for one side of the transaction, but not for both the payer and the payee. And sometimes that analysis can be quite finely balanced. One of the key factors we often look at is whether the payment by the customer to the commercial agent, the OTA, satisfies the customer's payment obligation or not. If the payment is made, but actually there's some other condition that has to be fulfilled before the contract is fully entered into, then that can be quite a strong indicator that the exclusion won't apply, and therefore you're not out of the woods. If your business operates in Europe as well, so the payment service regulations are based on PSD2, there is some divergence coming up with how that's implemented in Europe. There's PSD3 coming, and the Commission has been looking at tightening up that exclusion to make it so that it's not just purely pass-through terms, you pay this and then the standard terms apply. It's actually that to count as a commercial agent, you have to actually be really materially involved in the meat of the negotiations. So that brings on to the second exclusion, the limited network one, which you see, and it was originally conceived for things like closed loop payment systems for store cards, for fuel cards, anything where actually it's so limited in its scope that it shouldn't be treated as a payment instrument. Now, over time, that has been restricted in PSD1. It was abused, frankly, it was hugely overused. So in PSD2, they said, well, okay, we're going to apply this exclusion not just to a limited range of goods or services, but a very limited range of goods or services. No one's quite sure exactly what that means. What it does entail, though, is that if you are involved in a payment flow where payment is being made for a range of things, the broader you make that range of things, the less likely it is that you'll be able to continue relying on the exclusion. And to that end, one part of PSD2, which is now in the UK regulations as well, is that if you're using the exclusion and you're using it for more than €1 million of transactions annually, then you have to self-report to the FCA and say, this is what we're doing. These are the goods and services that can be purchased using this payment instrument or whatever structure it is, so that the FCA can have visibility of what's going on and they can make a decision about whether or not to intervene and say, actually, you need to get regulated now. Two other things I'm going to talk about briefly. Firstly, PCI DSS, which I'm guessing a great number of you will be familiar with. Those aren't. It's the Payment Card Industry Data Security Standard. It's technically not a piece of law. It is something that's been in place for a long time. It was invented originally by the card schemes and a number of the banks as a way of maintaining the security of card data, as it says on the tin. It's essentially a rather lengthy set of data security requirements, obviously a lot about encryption and storage, how things are held, how it affects third parties. It applies to anyone who's dealing with the PAN, the primary account number. That's the full 16 digits. So if you're only ever holding the last 4 digits, it doesn't count. It also applies to the SAD, the sensitive authentication data, so things like the PIN and the CVC. Virtual credit cards usually are in scope, but if it's a single use one, then it probably isn't. If it's a double use one, it's not entirely clear whether that is caught or not. People seem to take different views on that. It's a big topic because if you are dealing with that card data, and a lot of providers are, then the risk of getting it wrong is pretty significant. Although it's not a piece of law, they are the rules of the road for using the card schemes, which is how most people take payments. So it's a serious issue that needs to be taken into account. Last but not least, stable coins. I'm mentioning briefly because there's a lot of noise about them, and I find a lot of people don't actually really know what they are. Headline is they are fiat or asset-backed crypto. So instead of crypto that the value of which can fluctuate sometimes really quite wildly, this is crypto that is based on either fiat, so normal money being held at the back so that you've got a right to redeem against it, or some other kind of asset backing. There is regulation on it in the US. There is regulation coming in the UK under an amendment to FSMA. The FCA is taking its time on it a little bit. The reason I mention it in this context is because its main utility is international payments, getting money from one country to another much faster, much cheaper without a chain of banks in the middle. We are almost at time, so I'll hand back to Farina at this point for any questions.
Thank you, Chris. Yes, we have 2 minutes and we do have some questions. So I will answer some of them on the CMA guidance that has come through. So we've got a question here. If we've received a letter from the CMA, should we be replying? I mean, it depends on the content of the letter. I don't think that the advisory letters have been drafted to require you to respond, but my advice would be yes, to respond. If you think that actually you're already complying with these rules, you should be able to explain that to the CMA, provide evidence. If actually you think, yes, there are some changes that we need to make, you need to obviously make those changes. You could explain that in the letter. And of course, if you need any assistance responding to the letter, you are welcome to get in touch. We've got another question around the pay now, pay later. So where a customer pays in installments, it will be even more confusing if we have like the pay now and the pay later. I do agree that the pay now, pay later creates some confusion. Because there could be customers who think actually they've paid it all up front because it was included in the headline price when actually they haven't, and they're going to be paying some of it in resort. So I do agree that's an issue. Ultimately, the rule is the advertised price, the total price, has to include all mandatory fees and charges, and that's irrespective of whether the customer is then going to pay you all of that sum or whether the customer is then going to proceed to pay in installments. So it is all about how you just present that headline price. We do have, just looking to see if there's any other questions. Lucy, not a question as such, but a sort of a statement that I wasn't sure if you wanted to comment on. So in relation to sort of intermediary contracts, we've got an attendee that says, we've had experiences of the intermediary offering an indemnity, but when reading the fine print, it had so many conditions attached to it, like conduct of claims, caps, etc., excess, etc., that it was not accepted by our insurers.
Yeah, that's exactly the point. It might be a totally meaningless indemnity that you never rely on, and your insurance is key. If that indemnity is not accepted by your insurers, does that mean you're not insured for those claims, which is a bigger problem? So are you actually better not having the indemnity at all if that's the case? Yeah, all of that's a very, very good point. The fine print is the devil is in the detail.
And very, very finally, I'll just address it because we've had more than one question on this. So this is around the Regulation 29 right to redress and whether it actually is providing any strengthening of rights. In the consultation itself, you'll see they admit enforceability remains an issue, trying to enforce this against, especially if you've got suppliers overseas. So I definitely think that remains an issue, and that is something that the industry is going to have to grapple with. I think it does provide some clarity, and so I do think it improves the position somewhat. But I agree that yes, there are going to be enforceability issues that we need to deal with. We're not sure what the implications are going to be at this stage for if suppliers don't comply. That's something that I'm hoping we will get more guidance on, especially if we start seeing the draft wording, and if we can see whether there are any sort of penalties attached to not complying with that requirement. So I will end it there because we've overrun by 1 minute. Thank you all so much for joining our webinar. We will be sending these slides and a recording of the webinar out to everybody that's registered, so you will get it if you do want to watch it again at a later date. And with that, thank you all very much. Bye-bye.